Ladies and gentlemen, good day and welcome to Ethos Limited Q1 FY23 earnings conference call. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Yashwardhan Saboo, Chairman and Managing Director, Ethos, for his opening remarks. Thank you, and over to you, sir.
Thank you very much, and good afternoon, everyone. Thank you for joining us on the Ethos Q1 FY23 earnings call. I am joined by Mr. Pranav Saboo, the CEO, and Mr. Ritesh Agarwal, the CFO, and we also have SGA, our investor relations advisors, on this call. The presentation has been issued to the stock exchanges and also uploaded on our company's website. So I hope everyone has had the opportunity to review it. First and foremost, I am pleased to share that we have reported one of our best quarters for the company, recording its highest ever quarterly EBITDA and PAT. I'm sure you will also note that it is the result of Q1, which in our industry is considered one of the two leanest quarters without any major festive period and also not the wedding season. Q1 FY23 results have fared slightly better even than our best ever festive quarter, Q3 in FY22, on profitability metrics. Therefore, I'm sure you will share my optimism that the remainder of FY23 will be very good too, given the very good start that we have had to the year. I'm glad to share that after more than 2 years, the company has witnessed a normal working quarter free of lockdowns and COVID wave spikes. If things continue to be the way they are, we are destined to touch great heights in the times to come. Let me give you some highlights of the Q1 performance. You may know that the base Q1 of the previous year, that is FY22, was impacted by the second wave of Delta lockdowns. Hence, Q1 FY23 growth rates may look amplified. Nevertheless, Q1 FY23 results by themselves are an outstanding performance. As Ind AS 116 has a significant impact on our EBITDA and PBT, I am sharing the highlights of the financials without Ind AS 116 impact to give a simpler view of the accounts. I'm giving the figures of Q1 FY23 over Q1 FY22. Billings increased by 94% year on year to 201 crores. 26% of the billings in this quarter were contributed from exclusive brand watches. Consolidated revenue from operations increased by 95% YOY to 174 crores. Consolidated gross profit more than doubled to 54.7 crores, and the gross profit margin expanded by 300 basis points to 31.5%. Consolidated EBITDA increased by more than 7 times to 21.5 crores, and consolidated EBITDA margins expanded by 890 basis points to 12.2%. Consolidated PBT increased multifold to rupees 19.5 crores. Stock carrying months on sales stood at 5.2 months in Q1 of FY23, similar levels of Q4 FY22. Consolidated debt has been reduced from 60 crores in March 22 to rupees 29 crores in June 22. Cash and cash equivalents, including fixed deposits, stood at 307 crores as of June 22, and these will be utilized for the growth of the company as envisaged in the IPO in stages. Pleasing as these record numbers are, we are even more excited about the prospects for the current year and the years ahead. As is known, Quarter 2 and Quarter 4 are generally stronger than Quarter 1, and Quarter 3 is significantly the strongest of all quarters. Therefore, we continue to maintain our view and estimate given earlier in the year that the revenue growth in FY23 over FY22 will be as much as 30 to 35%. Our company's long-standing relationships with leading luxury watch brands will continue to underline and assist our company's ambitious growth plans and presence in India. We also believe these long-standing relationships with the luxury watch brands enhance our competitive position. In addition, we will also leverage our in-depth knowledge of luxury watches to expand the market for watches and establish a leading presence even in the segment of certified pre-owned watches. Before concluding my part of the speech, I would like to say that our focus going ahead will continue to be building our business based on the omni-channel strategy, exclusive brand tie-ups, a pan-India network, watch servicing and after-sales service, an extremely high standard of service to customers, and above all, the relationship of trust with our customers and with our brands. Now let me hand over to our CEO, Mr. Pranav Sabu, to share his thoughts. Over to you, Pranav.
Good afternoon, everyone. I hope you and everyone around you is safe and healthy. As Mr. Sabu has already given the gist of our strong Quarter 1 results, let me spend some time on the qualitative aspects of the business. We have built Ethos step by step on the back of our omni-channel strategy. Our physical presence is leveraged by our strong digital platform with a frequently visited website, effective social media communication, a large database of HNI customers, and an active program of home and office delivery of luxury products. Our digital platform has created a niche in the online luxury watch market through various unique value-added services, including a highly specialized team of luxury watch consultants, targeted content, watch insurance, and dedicated after-sales service to our customers. Our strong performance in Quarter 1 FY23 is also a result of all of these various initiatives we have taken over the years. Out of the total billings of 201 crores in Quarter 1, nearly one-third of our business is now coming through digital mediums. This itself speaks about the strength of our digital presence now. Apart from that, we have also made progress in our focus area, which is expanding the list of exclusive brand portfolios. Post-listing of Ethos, we have added 2 new Swiss brands to our exclusive brand portfolio, Jacob & Company and Norcom. These partnerships will unlock access to the brand's unique collections for Ethos customers pan-India. With these additions, now 35 of the biggest watch brands are available exclusively at Ethos. Relationships with luxury brands and their owners typically take many years to develop and are difficult to
while on the other side, the demand for these iconic and luxury brands and watchmaker brands, they have been steadily going up as they have become collectibles and pieces that people want to collect. So the demand has been going up. The supply has not kept pace completely. So there is a shortage globally. The allocation is really a policy that the brand follows. It's not something that we can comment on. However, I do want to say that for most brands, India is rapidly becoming a high priority market. And certainly we understand that, and the brands understand that India will be one of the most important markets in the future. So it certainly also stands pretty much high in the order of importance when it comes to allocation.
Oh, sir, can I have asked a few more questions? Yes.
Sam, may I suggest if there are other questions, so maybe you can come back at the end.
Okay, sir. Thank you. Thank you, sir.
Thank you. The next question is from the line of Prerna Chaudhary from Ace Capital. Please go ahead.
Hello, everyone. First of all, I'd like to congratulate you for such an amazing quarter. And my first question being, can you give some insight on a new jewelry and luggage retailing business, how it has been doing, and what is the scalability potential? And the second one being, what is the total working capital cycle in our days for our company?
Okay. Prerna, thank you very much for your nice comments. The second question, I'm going to transfer that to our CFO and CEO to answer. The first question regarding the new jewelry and luggage business, let me answer it for you. We have signed on Remova for the luggage, and Remova, as you know, is LVMH group company. It is the best known, the most famous luggage brand in the world today. And jewelry, we've signed on with Messika Paris. I will urge you to check out Messika Paris and how well known it has become, especially among the younger generation. It actually was chosen by many stars at the Cannes Film Festival in 2022. Now, both these brands we have signed on, but we are still waiting for stores to become available. Remova, we're going to start at the Geo World Plaza Mall in Mumbai, which is expected to become operational in February. And Messika, we will start in the third quarter of this year. So the businesses, we are in the planning phase, but they have not yet started. So the upside and all the numbers from these two exciting businesses are still to come in. These are very exciting segments. Jewelry, especially branded jewelry, is booming worldwide, and including in India. We all know what Tanishq did, how it transformed the branded jewelry business in India over the last 20 years. From unbranded jewelry became branded, and Tanishq was the one that led that transformation. We believe that that same transformation is going to continue with branded jewelry, but this time around with international branded jewelry. The same thing which has happened in so many other brands. So international branded jewelry like Messika is going to experience a huge growth, and we are extremely excited to have this possibility with an exclusive tie-up with Messika. Luggage, business luggage, like Remova, COVID is over, traveling is back. If you've seen how rapidly traveling is growing back again, international travel, business travel, holiday travel, I have really no doubt that Remova itself will be a highly scalable business. We are starting with one boutique, but I'm sure there will be others to follow, because we have a large Indian market to cater to. It's difficult to put numbers right now. Let us start, let us see the reaction. But I think in the years to come, it's going to be a very significant contributor to the company's revenues and profitability. I'm going to pass the mic on to Ritesh and Pranav to answer the question regarding inventory, I think.
So our inventory days as of June is 154 days on sales, and the working capital days is 110 days.
Thank you so much, sir. That's all from my side.
Thank you, Prerna.
Thank you. The next question is from the line of Devanshu Bansal from Emkay Global Financial Services. Please go ahead.
Yes, hi. Thanks for the opportunity, sir, and congratulations on a great set of numbers. Sir, most of the store openings that were part of our issue objects are expected to be in FY23. So can you throw some light on the timeline of these openings within FY23?
Devanshu, nice to hear you. If you have other questions, can you put them all in one so that we can answer them all?
Sure. And the second question is, you mentioned exclusive mix was 26% in this quarter. What was this mix in the base quarter, Q1 FY21? And if you can provide for Q1 FY20, then it would be helpful over the last 3 quarters. And
you have to repeat that question. It was not very clear.
You mentioned exclusive mix to be 26% for this quarter, Q1 FY23. If you can mention the exclusive mix for the last 2 quarters in the base, Q1 FY22 and Q1 FY21.
Okay.
And third is, you indicated there has been a shortage of luxury brands. So are you seeing discounting sort of reducing for the luxury watches? And last question is on the contribution of pre-owned watches. So what was the revenue contribution in this quarter? And how do you see the profitability trajectory as this business scales up? So, yeah.
Okay. Let me answer about store openings, and some of the data I'll transfer the mic to Ritesh and Pranav. On store openings, we are anticipating store openings starting from the next quarter. As I mentioned, all the store openings, new store openings depend on the availability and when the malls become ready. So we're expecting Indore and we're expecting Ahmedabad, 2 malls that I mentioned already, Geo World Plaza in Mumbai in the 4th quarter. We are informed they are on track, or usually, a month or 2 of delay. We are tracking it, and we are hopeful that the store openings that were planned for this year will continue. As far as the discounting is concerned, yes, we do see a steady reduction in discounts. So that's a very positive development from the margin point of view. And that's one of the reasons why you will see the margin improvement. Pre-owned watches, the sale in this quarter was more than 3x of previous year's same quarter. And as I mentioned, the overall profitability and return on capital on this business, especially after it crosses a threshold, is actually going to be higher than the return on capital of the new watch business. And the reason is that obviously it's a more efficient business in terms of costs. All the sales that we are doing is coming from one store and our website, all the sales that we are doing. Regarding the percentage of share of exclusive brands in the previous quarter, Ritesh, you will have the numbers readily with you. Can you share them, please? why we are pushing for more flagship stores. Let me add one other reason why flagship stores make a lot of sense, and that is that the same store growth can be sustained for much longer in a flagship store. So when you build up a flagship store, it becomes the center of customers' watch experience. And then for years and years and years, we can expect same store growth to remain strong. This is the trend globally, and this is what we are seeing in India as well.
Right, okay. Thank you.
Thank you.
Thank you. The next question is from the line of Rahul Agarwal from Indirect Capital. Please go ahead.
Yeah, hi. Good afternoon, and good to see a very strong.
Nice to hear you.
Yeah, same here, sir. So good to see a very strong set of numbers. Sir, three questions quickly. Firstly, on gross margin, I think we're tracking much higher than what we've done historically. What could be a reason? As in, obviously, presentation mentions that in-house brand share is increasing. But my sense is quarter on quarter, it looks like we've gone from 28 to 26, but we've still expanded gross margin. So could you help me understand this and bit of long-term range, as in, as the previous participant was asking, that obviously we're all trying to sustain this number, but is it really sustainable? That's first question. Second was on same-store sales growth. You know, we hardly had any new openings this quarter, but it looks like the same-store sales growth was very strong, driving overall top line. Could you elaborate a bit on, you know, give some color on whether it was driven by volumes or sales mix, or, you know, the watches you offer are better, the demand post-COVID continues on luxury items, you know, and any other reason you think like. And, you know, third was, you know, on currency depreciation. We saw a very large depreciation of Indian rupee versus dollar. How does that impact the business? Those are my three questions. Thank you.
Great questions, Rahul, as always. Gross margin, look, as I mentioned, gross margin is a result of various things. Among them, one of them is share of exclusive brands, where the margin is larger. But here you've seen an expansion of margin, even though the share of exclusive brands has actually gone down a bit in this quarter. So clearly, there are other forces that always play. A reduction in discount related to the fact that some watches, you know, generally in the market there has been a reduction in discount. In the days when, you know, 20 and 30 and 40% discounts were being talked about, those are gone forever, and that is good. A very, very important part is the processes that the management team has put in the purchasing process. The selection of products, the use of data to check what is going to sell, what are the preferences. So over the last 18 to 24 months, a lot of work has been done in streamlining this process. And obviously the quality of the inventory we have, the time when we have it, where we have it, that has played an important role also in enhancing the gross margin. You mentioned currency depreciation. It is somehow related a little bit to the gross margin as well. As long, you know, currency depreciation in dollar has been strong, but dollar has risen against other currencies like Swiss franc as well. So the currency depreciation in Swiss franc has been relatively low. Prices have been stable. So this usually also helps in gross margin sort of stability. Sometimes, you know, gross margin is impacted because of these things. Since this impact was less, it has remained stable. And lastly, I would also like to say that, you know, our merchandising team, they've done a very great job in negotiating terms with brands, whether it's for specific products, whether it is for, you know, specific markets or specific campaigns, combined with a very focused marketing program. So I think it's a multi-various kind of effort which has led to gross margin solidifying. Your question as to whether it is sustainable, whether it's really sustainable or not, as I said already, our effort is not only to sustain it, but to improve it. We will try to control and improve all the factors that are in our control. What is not in our control, we cannot. But in the past, you have seen that when the environment remains stable, right? At that time, you see all the positives coming through as has happened this quarter. And I'm very confident that going forward, this is going to continue and we should be able to sustain this margin. Same-store sales growth, you're right, there has not been any new openings, and same-store sales growth has been high. Again, a lot of it due to some of the factors which I already mentioned. A very great and focused effort of the management teams to on same-store sales growth, better merchandising, better product availability, and so on. You mentioned, whether demand has peaked after and stayed high after COVID. So there has been this tendency to believe that during COVID, demand went up because people couldn't travel or people had extra money with them. They didn't know what to do. They were sitting bored in their homes. I'm not sure if that is true. What I'd like to believe is this, which I have said over the last 24 or 36 months. India is reaching to a tipping point where the income grows, the GDP per capita income and the wealth of India is reaching a point where discretionary spending is taking off. COVID intervened, so all kinds of trends got mixed up, but COVID has gone. Indians have traveled widely all across the world in the last 6 months, and yet we see the demand continuing to remain strong. It shows that India is now ready to buy discretionary products in the luxury segment. Two other things have happened. More and more we find Indians preferring to buy watches in India. It was the time when everybody said, we are traveling out, we'll buy watches. Today we have calls from friends and travelers almost every week. Either they've just come back from traveling abroad or they're already traveling abroad and they come back and say, look, what is the use to buy outside? Don't you think we should buy in India? Of course, not only because the prices are competitive in India, but also because there are so many other advantages. Service is better. You get all the documentation. You have a trust that everything that you're getting is genuine. The ability to sell a pre-owned watch with the right documents. There are at least 4 or 5 clear advantages to buying in India, and customers are discovering it. That's another reason why demand has been strong, and this is a structural change, Rahul, what I want to mention. This is not a flash in the pan. So this is going to stay. And the third thing which I want to mention is, clearly Ethos has emerged as the retailer of choice in India. We are the largest footprint, greatest digital presence, greatest digital and in-store experience. So while Indian demand is growing, it is shifting from outside to India. Within that, Ethos is the retailer of choice. These are 3 structural changes. It's a sangam of 3 very positive influences which will combine into a powerful engine for growth for Ethos in the years and quarters to come. I'm convinced about that. Currency depreciation, your last question. I think the writing is on the wall. There will be a currency depreciation in the months going forward. But this is no change. You look at the last 20 years that Ethos has been in business, or the last 40 years that I have seen in business. There is a depreciation of the Indian rupee on an average 4 to 5% every year. Our businesses in India have to factor that in as we have factored in. It might have changes and consequences for 1 or 2 quarters, but we are not looking at 1 or 2 quarters. We are looking at the next 3, 5, 10 years, and we will establish a fabulous leadership and a fabulous business over this period. Know what happens with the currency.
Got it. But just to be clear on the currency part, my understanding is short term, if the currency depreciates suddenly, our import cost goes up and there is a time lag to pass
which is why you see a gross margin increase happening despite house brand sale decreasing a little bit. Just to explain the first question, just my view on it. Thank you.
Thanks, Pranav. That was very helpful. Yeah.
Thank you. The next question is from the line of Maithili Balakrishnan from Alchemy. Please go ahead.
Hi. Couple of questions. One on the ASP. Could you just help us understand how it has moved?
Can you speak a little louder, please?
I was curious about how the ASP has moved, how the average selling price has moved in line with our strategy of premiumization in watches.
Okay. Are there any other questions that you have?
I also wanted to understand the top 5 brands contribution, and if you could share the the pre-owned, how much of sales came from the pre-owned business. You mentioned it went up 3x, but I didn't catch the exact number.
Would you like to about ASP and the top brands and the pre-owned business, Pranav or Ritesh? You would have the numbers more readily. Would you like to answer that, please?
Our ASP is moving upward, as we mentioned during our last call as well. So in this quarter, our ASP is 1,58,000.
Got it. In terms of the top 5 brands?
So we do not mention about, we do not brand, but we work with all the brands, respective brands work with us. So the brands like brands from Choice Group, Rolex, all these brands are important, as well as our house brands with exclusive brands like of Overk and many other Bowe. All brands are very dear to us, and we track all those as an important point for us.
Got it. And in terms of the pre-owned, if you could share the exact percentage.
Pre-owned is about 6%.
Got it. In terms of the store openings, just wanted to get a sense, right? Because we currently have 50, we plan to open 3 or 4. Will we be also looking to relocate or move some of the older, smaller stores into this new format?
We are constantly, this is Yasho Sabu here again, we are constantly reviewing locations. And yes, if leases come to an end, obviously that's the time when we review, and if either we've got a better location or a store is not performing as per required standards, then we would close it and shift to another location. It also depends on how the market has evolved, whether how much of an overlap there is with another store. So I don't think there's one reason. There are plenty of reasons why a store may be discontinued or continued. Overall, the direction is to move towards larger store, flagship stores, and away from smaller stores.
Got it. But then, to that extent, our sales will be faster than the store addition per se, right? Significantly.
Yes, in a direct logic, yes, but don't forget that our stores also include mono-brand stores. And mono-brand stores are typically of the size of 400 to 700 or 800 square feet. And mono-brand stores obviously don't have the same kind of sales that a multi-brand store has. However, there's another logic for mono-brand stores. So if you really were to do a sort of arithmetical calculation, you'll have to separate mono-brand stores and multi-brand stores. And in multi-brand stores, the sales will increase faster than the store count. That's right.
Got it. Thanks. That's all from my side.
Thank you.
Thank you. The next question is from the line of Vinayak Mohta from Stallion Asset. Please go ahead.
Yeah, hi. Congratulations on a great set of numbers. I basically had 2 to 3 questions. So just to start with, wanted to broadly understand how does the ROICs for a particular store work, and given that you'll eventually be moving into expansion mode even further, and given the working capital requirement that you need. So how do you look at the return on capital, going ahead into the future? I understand that you're in a, growth phase for now, but how do you see this requirement of capital and the ROCs evolving as we move forward? The second question was, what stops the ultra-rich people who, come to buy a Rolex or a higher-end watch somewhere around 10, 15, 20 lakh rupees to not go and, buy abroad? Like, is it the pricing differential? Because a flight ticket barrier to them. So what stops them from going to a Switzerland or anywhere else for that matter and buy a watch from there? And the third question was, what goes into your understanding of, while you're opening a particular store, what goes into your understanding? What do you look like? Is this a place good for exclusive brand outlet, or is this a place better for a multi-brand outlet? So yeah, broadly these three questions.
Right. So return on capital obviously is the final arbiter, right? Everybody is working to get a high return on capital. And as you very rightly said, in a growth phase, there's always a balance between growth and what is the ROC that you get. However, going forward, as was explained in earlier conference calls, as well as our other discussions, as we go forward, there are several factors and impacts that we have to take into account. First of all, the working capital will not grow proportionately. So from that sense, the return on capital obviously will increase. We are already seeing the impact of margin improvement on that. Going forward, as in the previous question, exchange, I answered that the store count itself will not go up as fast as the sales is going to expand. So again, our expenses will not expand as fast as sales. Operating leverage is starting to kick in very clearly, and that again will lead to an increase in the return on capital. Finally, let's say a new business like the pre-owned watches. I'm not sure if you heard the first part in the first question itself, where it was that the return on capital on pre-owned watches we estimated to be higher than other businesses because it's much more efficient. We will the current sales is being generated from one store. For all the business projections that we have, we intend to open only about four stores across the country for pre-owned watches in the next 2 to 3 years. So again, these are impacts which will have positive impact on the ROC. So I believe that the ROC will show a steady improvement from here, and our goal is to become one of the strongest growing and highest paying ROC companies in the retail business in India. It's difficult really to make very exact projections, but largely I can also say that for our goals through the IPO, we have enough capital and we don't need more capital. We need to invest this capital wisely and to make sure that it leads to the desired growth, not only in turnover but also in profit. Yeah, second question was about ultra-rich and what stops them from going to Switzerland and buying. Well, that's what they've been doing for the last 40 years. And now they're coming back to India. Why? First of all, they're realizing that India is as good a place as anywhere abroad to buy watches. Prices are probably less in India. They are certainly not more than other markets. The selection of products and brands today, which is offered by Ethos, is equal to anywhere else in the world. But they are discovering the other advantages. They can buy a watch officially with all the papers. They can get the watch insured. They can show it on social media. The service that we offer today in India, I can proudly say, and you can talk to people who have shopped abroad, the service that they will get at Ethos India, whether it's after-sale service, whether it's our white glove service, which will deliver the watch to their home, which will pick it up from their home or office if they want it serviced. Name me one store in a Switzerland or a Singapore, if you go to the hotel and you ask, please deliver the watch to my hotel, they are not going to do that. So the service, the respect, the relationship with the customer that Ethos offers, and the trust and the paperwork and everything being legitimate, people and collectors are discovering this. Does it mean that there is nobody buying watches abroad? Not at all. There are lots of people still buying watches abroad, but gradually this is all shifting gradually to India. So that points to the great potential we have of growth. there are still large numbers of Indians who are buying watches abroad. And we are very sure that more and more of them are going to buy in India because everything favors buying in India. So I am convinced that people will buy, and I'm sure you will have friends and family who will know, who have traveled abroad. Ask them, will they find a difference between buying abroad or buying in India? 8 out of 10 will tell you we prefer to buy in India. So that is not a worry at all. And there was a third question which you had, Vinayak. I'm sorry, I think I lost it.
So broadly, instead of the third question, I broadly have this question like, if I just do a back of the envelope calculation, we are selling around 2 watches per day per store. What initiative is the company, or what are you doing differently that this moves to a 3 watches or a 4 watches per store? Because now, given that you'll be opening lesser numbers of stores, the same store sales is the major factor driver out here. So what do you think you would be doing differently? And just to follow up on the ROC question, how does the unit economics on a second-hand watches work, and how do you think this will be a scalable market going forward? Thank you.
That's a very detailed question, and perhaps our CFO and will be glad to connect with you to discuss that. But overall, in terms of driving same-store growth, it's not a question of doing things differently. We are already doing things differently, which is leading to this high sales growth. Our omni-channel platform is actually designed for that. It is yielding that. Right? My store is not only catering to the 10 kilometers around that store. My store can be catering to 100, 200, 500 kilometers around that store. Not only that, my 20 stores which carry a particular brand, collectively they cover the whole of India. So it's not that only the store in Chandigarh will supply to a customer who's sitting in Jammu. If that stock is held in a store in Bangalore or in a Kolkata or in a Guwahati, he can very well supply the customer in Jammu sitting from there, or a customer in Kochi or in Bhubaneswar can be supplied from a store in Jaipur, depending on where the stock is. So this is the kind of optimization that the omni-channel platform ensures, and our digital communication and storytelling about the brand, the selection, keeps up the interest. Younger people are getting more and more interested in mechanical watches, in Swiss watches, because it's the best platform to buy it. So I have really no doubt that what you mentioned, same-store growth, you're already seeing the signs of that, and that is going to continue.
Understood. Just one last question. Just trying to understand the competitive advantage here. What stops a Titan to come into a high-end watches, or what stops any competitor to come and kind of not disrupt but take away a market of their own? Because this is still not a very niche, but it's still a growing segment at a very fast rate. So what stops something like a Titan who has experience in the watches end to come into the higher end?
Titan is one of the greatest companies that I know in India and I work with. I don't know what stops them, but what I do know in the last 18 years that we have been in business, Titan has not been in the high-end business, and we have been. So I don't know why they can't make it. There must be some reasons. They might have tried. I know that they have tried. They had a luxury brand, Faber Luba, but Titan is a great company, but I don't think their focus is luxury watches. A lot of their focus is actually jewelry, and it takes a different set of skills and attitude and focus to be in the luxury business. Titan has been extremely successful in all the businesses they have been, but they have not really adopted the luxury business.
Understood. And can you give some light on the luxury car business?
There are other people waiting with questions. So if you have other questions, maybe we can come back later.
No worries. Thank you so much, and all the best for the...
Thank you.
Thank you. Anyone who would like to ask a question, you may press star and 1. The next question is from the line of Ekta Sanghvi from Vallum Capital.
Good evening. Thank you for the opportunity. So I just have 3 questions. The first one being, what can we expect our CPO contribution to the revenue to be in the next 3 years? And also, is the margin profile of the CPO business similar to the exclusive brand? And the second question is, how do we decide about the store opening in the tier 2 cities? Like, is it that the cities where the digital demand is high, and then we are going and opening stores in those cities, or is there what is the whole methodology for deciding on which tier 2 cities to approach? And the third one is that so how many retailers of Rolex are there in India, and why would we be a preferred retailer of the brand? Because the brand itself has very high brand equity. So why would a person not go to any other retailer and come to Ethos?
Right. About the CPO business, we expect in the next couple of years, the CPO business to grow at close to triple figures percentage growth. So again, it's difficult to put exact numbers over there, but we see an extremely strong growth, and we believe we will be high double digit or possibly even triple digit growth over the next 2 to 3 years in the CPO business. The margin in the CPO business is similar overall to the business of new watches, maybe slightly lower, but the return on capital is higher. The margin on the sales is a little bit lower than the overall average, but the return on capital is significantly better. As far as store openings in third and tier 2 and other cities, yes, you're absolutely right. We use data. We use a lot of data, not only from our own website, the traffic and the responses that we get, which is extremely valuable, by the way. Say which are the cities that are exhibiting the highest interest in luxury watches, but we also go by other data of luxury retail, which are the presence of other luxury brands. For example, if there is a high quality mall coming up, we rely on the research done by the mall. A mall is investing thousands of crores to build it, and if they've got luxury brands, then they have done research, and we rely on that research as well. So pretty much our decision on where to open stores is very, very heavily data driven, which increases the chances that it will be a success and a quick success. Your last question was, why is it that any customer should come to Ethos to buy a particular brand, which may also be available with other retailers? It's not only true of Rolex, it's true for so many brands that some other retailers also carry. However, there must be a reason why for most of these brands we are the largest partner for brands. And I'd like to believe that at Ethos we have grown. Let me put it like this: almost all the retailers who carry other brands of luxury watches, they've all been in business far, far, far longer than Ethos. They were in business even 10 years before Ethos started. There must be a reason that Ethos, starting from scratch, has actually far outpaced and grown and straddled the entire country very successfully. And I'd like to believe it is based on the promise of Ethos, which is to offer the best luxury watch products, premium watch products, brand and selection at a competitive price with 100% guarantee that what you get is genuine, what you get is new, what you get is of the highest quality equivalent to anywhere else in the world. That's, I believe, the reason that Ethos is a preferred retailer for many, many, many buyers.
Thank you so much. Just one clarification. So is it that we have more collection than the other retailers on an average? Like more selection of the...
On an average, yes. On an average, yes. We carry more brands and more number of SKUs than any other retailer. You can, you don't have to take my word for it. You go on the internet and you check that out. There other retailers also have websites, so check it out. What are the number of brands we carry? What is it they carry? How many S they carry? Visit a store. So yes, it's right. What you said is absolutely right.
Okay. Thank you so much.
Thank you.
Thank you. The next question is from the line of Vinayak Mohta from Stallion Assets. Please go ahead.
Yeah, hi. Just wanted to understand, what are you, how are you approaching the luxury car business, and what kind of scalability can you look at out here?
Luxury car business, we're not in that business, so we're not really approaching that business. It is something that we put in our articles as an enabling clause, because in the luxury business, I think cars is an important part, and luxury cars have a certain affinity with luxury watches. People who buy luxury watches are similar to people who buy luxury cars. So there isn't really a clear thinking on this yet.
Understood.
Okay, thank you.
Thank you. Anyone who would like to ask a question, you may press star and 1. The next question is...
please go ahead.
Thank you. The next question is from the line of Rahul Agarwal from Indirect Capital. Please go ahead.
Yeah, just one bookkeeping question. Thanks for the opportunity again. Ritesh, if you could answer, what is the absolute number of inventory as of June, and what was the operating cash flow for the quarter?
Rahul, our inventory as of June is 280 crore. And with respect to operating cash flow, I will come back to you.
Okay, sir. Thank you so much. All the best.
Thank you.
Thank you. The next question is from the line of Vinayak Mohta from Stallion Asset. Please go ahead.
So, sorry, sir. Just one clarification. The 30 to 35% growth number that you have mentioned, this includes the second-hand or the pre-owned watches segment as well?
It's the overall number.
Understood. Great. Thank you so much.
Thank you. The next question is from the line of Shubham Agarwal from Indirect Capital. Please go ahead.
Hi, sir. Thank you for the opportunity. Just one small question. Most of the questions have been answered. With respect to the inventory for pre-owned, do you face any? You intend to grow triple digits from here. So how is the supply? Do you see any constraints there? Need to import pre-owned watches, or would all be sourced from India? Just trying to get a sense of inventory available to sell. That's all.
So pre-owned watches, Shubham, they are sourced from individuals in India. We do not import used watches, pre-owned watches, not one. So that is the first question. If there is in the business of pre-owned watches, I can tell you the demand for pre-owned watches is significantly more buoyant than the supply. So there is a huge demand for pre-owned watches, and we are gearing up to be able to meet that. But it's not only a question of supply. You see, it's important to understand that not only do we have to connect with the sellers of the watches, we have to reach an agreement with them on prices. Sometimes they have a very exaggerated notion that, my watch, it is 50 years old and therefore it must fetch a very, very important antique price. That is usually, or very often, that is not the case. But even more important, after we have sourced the watch, the important process then starts, which is of checking the watch, verifying that it is a genuine watch, repairing, or not repairing, but restoring the watch, which sometimes requires ordering spare parts, making sure and testing that it is up to the required standards, and then certifying it from Ethos. And that is the most important thing, because each watch has this certification from Ethos that it is a genuine watch, it is restored, it is in good working condition. And after we are done with that restoration, if I put a new watch and a restored watch in front of you, it will be very hard to tell which one is the restored watch. The quality of restoration is so high. Why I am emphasizing this point is that the process of restoration, that is not an automatic process. That has to be done by very skilled watchmakers, and watchmakers who have experience not only in one brand. We are buying many brands and selling many brands. So they have to have experience across brands. And this is a highly skilled and technical thing. We have expanded. We've got today the best and the biggest watch service and restoration center in India. And we have trained 17 watchmakers for this job. And we will need more. So actually that is the bottleneck. And as on this capacity will be expanded, we will be sourcing more and more using our network of buyers, and we will see this thing to grow.
Thank you. So just, I don't know, I can squeeze one more question, wasn't coming to me earlier, but what inventory days do you run at for CPO business in general?
For what? For pre-owned watches?
Yeah, pre-owned, yeah.
So it usually takes about, from the time a seller agrees to sell the watch, and then we need to restore it. It can take on an average 4 to 6 weeks for the restoration. But after it has been restored and available for sale, typically there's less than 1 month of stock. Watches sell out very quickly after they've been restored.
Thank you for the opportunities.
Thank you.
Thank you. As there are no further questions from the participants, I now hand the conference over to the management for closing comments.
Thank you very much, and thank you everybody for joining the call. I hope we've been able to answer most of your queries. If there are any remaining, please contact SGA, our Investor Relations Advisor, and they will surely direct them to us, and I hope we will be able to satisfy all your questions. Thank you once again for your participation, and I wish you a nice afternoon and a nice evening. Thank you.
Thank you. On behalf of Ethos Limited, that concludes this conference. Thank you for joining us, and you may now disconnect the line.